So how likely is it that there will be an increase in inflation? Well, those who are concerned about that can certainly point to some significant intensification of inflationary pressures at the top of manufacturing and in some cases services sector supply chains. For example, the surveys conducted by the Federal Reserve Bank of Philadelphia, which, as it happens, covers an area that's a pretty good microcosm of the US economy, shows that there are significant increases in the prices being paid by both manufacturing and services firms for inputs into their production processes, and that manufacturing firms in particular are actually able to pass on a good deal of those price increases to their customers, as you can see from the prices received component. The more widely followed ISM, or as they're usually called in other countries, PMI, Purchasing Managers Indexes surveys, likewise show that firms are having to pay up more for the inputs they use in their production processes. Some other useful gauges of upstream inflationary pressures, such as the one compiled by the Federal Reserve Bank in New York, import prices, which speak to similar pressures upstream in goods production processes in other countries that send goods to the United States, so showing increases in prices, and the producer price index itself, which measures the prices of goods coming out of factory gates, is now rising at its fastest rate in almost 10 years. And that increase in producer price inflation is also mirrored in a whole raft of other countries, including Japan, China, other Asian economies such as Korea and which reported today Malaysia, and of course in Europe also, we're seeing in countries like Germany a significant acceleration in price pressures at the consumer level. Some of the increase in annual inflation rates is of course an echo effect of the falls in consumer prices that occurred between March and June last year, particularly as a result of lower petrol prices. And you can see that, for example, in the US CPI, which jumped to 2.8% over the year to March, and almost certainly will top 3.5% in May because of the combination of negative CPI increases, that is falls in consumer prices month on month, dropping out of 12-month calculations, combined with the upward movement in crude oil prices that's been reflected at petrol pumps over the last few months. So there's almost certainly going to be a temporary spike, at least in headline inflation, but it's not clear that that's going to be reflected in an acceleration in underlying inflation, at least in the next 2 or 3 months. And for the most part, medium-term inflation expectations, as reflected in surveys of consumers, or for that matter in bond market pricing, remain reasonably well anchored in the language of central banks. And that's important because in the way that central banks think about inflation, they are particularly concerned if people and businesses come to expect that prices will rise at a faster rate, because if they do really expect that, they're likely to behave in ways that make a higher inflation rate more likely. For example, by demanding higher wages, or by willing to pay higher prices for imports in the expectation that they'll be able to claw that back from their customers by raising their own prices. And of course, we know from history, from the period from the mid-1960s until the early 1980s, that if inflationary expectations do become unanchored, if people and businesses do expect prices to rise at accelerating rates, then you're sort of almost halfway there to that actually happening. One reason why to date there hasn't been any sustained acceleration in so-called underlying inflation rates is because there hasn't been any significant acceleration in labour costs, which, especially for services firms, are the biggest component of their overall cost structures. Although crude measures like average hourly earnings appear to have spiked during the pandemic, the reality is that that's because most of the job losses have occurred among lower paid and casual workers. So if you take them out, the pay of those who've remained in the workforce, almost by definition, tends to go up. Measures of wages costs that abstract from compositional changes in the workforce, like our Australian wage price index, or its equivalent in the US, the employment cost index, don't show any acceleration in wages growth over the past year. Likewise, the Fed, the wage growth tracker that's compiled by the Atlanta Fed that uses micro data to track the changes in the hourly wages of individuals in their jobs, hasn't shown any acceleration in wages costs. And although the measure of unit labour costs, that is labour costs adjusted for productivity changes, do appear to have ticked up in the non-farm business sector as a whole, that almost certainly reflects difficulties that statisticians have had in measuring productivity during all the enormous upheavals in workplaces over the last 9 to 12 months, rather than reflects a genuine underlying trend. And you can see in the manufacturing sector, those fluctuations have been even more marked. And of course, the reason there hasn't been any underlying increase in wage inflation is because, as I mentioned earlier, there's still an awful lot of slack in the labour market. There's still a quite high unemployment rate by historical standards. And particularly in the US, there's a fair measure of hidden unemployment, as reflected in the decline in the labour force participation rate, not only since the onset of the pandemic, but really since the late 1990s, before the tech wreck actually happened. For its part, the Federal Reserve has made two important changes to the way it interprets its mandate from Congress to achieve both low inflation and full employment. That's the Fed's goals as laid out in the 1978 Humphrey Hawkins mandate. Now, since Ben Bernanke's time, the Fed has said it's been aiming for 2% inflation, a bit like Europe. Not quite as flexible as Australia's Reserve Bank, which has a 2 to 3% on average inflation target, and it's had that since it first promulgated it in 1993. The Fed has also traditionally interpreted full employment as being consistent with an unemployment rate of 5%. And going back all the way to the 1950s, the Fed has typically seen it as necessary to start raising interest rates as the unemployment rate has approached 5%, for fear that if they waited until the unemployment rate actually dropped to 5% or lower, inflation would have already started to accelerate, and it would have required bigger increases in interest rates in order to bring it back down to its desired level again. That's why famously the long-serving chairman of the Federal Reserve Board in the 1950s, William McChesney Martin, used to say that the job of the Fed was to take the punch bowl away before the party really gets going. But the Fed under Jay Powell has adjusted its inflation target from 2%, in all times and in all places, as it were, to what they now specify as an average of 2% over time. Now, in saying that, the Fed isn't meaning that in the same way that our Reserve Bank does here in Australia when they talk about targeting an average inflation rate or an inflation rate of 2 to 3% on average over the course of the business cycle. What the Fed's actually saying is that because inflation has been below its target for such a long time, in particular since the end of 2018, but in reality since the aftermath of the financial crisis in 2008-9, they are willing to tolerate a period when inflation is over 2%, so that if you take an average over a period either from the end of 2018 or indeed some would have it since 2010, on average the inflation rate has been 2. And that in a sense amounts to a de facto targeting of the price level rather than the rate of inflation, as I hope you can see from the chart on the left. The green line in that chart shows what the PCE deflator, the private consumption expenditure deflator, which is what the Fed actually targets rather than the consumer price index. That shows you the level of the PCE deflator if inflation had been steady at 2% per annum since December 2018. The solid purple line shows what the actual level of the PCE deflator excluding food and energy has been since December 2018 up to February 2021. We get the March data on Friday. And the dotted line then shows what inflation would need to be, how the level of the PCE deflator would need to move in order to get back to where it would have been if it had been a steady 2% by the end of the year 2023. And as a matter of mathematics, what that means is that if the Fed were willing to accommodate sufficiently high inflation to get the level of the price deflator back to where it would have been at the end of 2023 if inflation had been 2% steadily, then in effect, they're targeting an average inflation rate of 2.4%. Now, that's not going to be an easy thing for them to explain, but I would expect them to keep trying to do it over the next 2 or 3 years. The other significant way in which the Fed has changed the way it interprets its mandate is with regard to the employment objective. As I mentioned before, traditionally, the Fed has interpreted full employment as meaning the so-called non-inflation accelerating rate of unemployment, the rate of unemployment that is consistent with wage and price inflation staying stable. But under Jay Powell, they've changed that to the maximum sustainable level of employment, and monetary policy decisions are going to be guided by whether the level of employment is below that maximum level, what they call shortfalls in employment from its maximum level. They're not going to be concerned about employment being higher than the level that would have been consistent with the old concept of the NAIRU, the non-accelerating inflation rate of unemployment, unless they see signs that wage and price inflation are actually accelerating. And that means that the Fed in practice is going to be willing to allow the unemployment rate to fall a lot further than they have ever been before they start responding to it by lifting interest rates. And so when you bring those two things together, it's clear that the way in which the Federal Reserve will respond to data on unemployment and on inflation is going to be different from the way that it has been in the past. One of the other reasons that the Fed has changed the way it interprets its employment target is because it really has bought into the view that there are things that monetary policy can do to promote lower unemployment among racial minorities within the United States. As this chart shows, the unemployment rate among African Americans or blacks and among Hispanics or Latinos has been consistently higher by wide margins than among whites in the United States, and that the margin always blows out during recessions, as it has done during the most recent one. What the experience of 2018, 2019 has taught both the Federal Reserve and Americans more broadly is that if you allow the unemployment rate to get down to an overall average of about 3%, groups within the American population, the workforce, who typically find it harder to get jobs, and if they do get jobs, harder to get pay rises, find it much easier to get jobs in those circumstances when the labour market is tight. And that's why Trump was actually correct to say, and he wasn't correct about many of the things he asserted about the US economy, he was correct to say that the unemployment rate among African Americans during the latter part of his term in office before COVID hit was lower than it had been at any stage in post-war American history. Now, that wasn't necessarily because of the policies he was pursuing. In most respects, it was because the administration and the Fed allowed the steady downward trend in unemployment that had been occurring under the Obama administration to continue more or less unabated. Although, as you know, in 2018, the Federal Reserve did start to raise interest rates before stopping doing that at the beginning of 2019. But I think the lesson the Fed and others have drawn from that experience in 2018-19 is that you can actually let the unemployment rate fall further than had previously been thought feasible before wages growth starts to accelerate. And that's certainly the other piece of evidence you can draw from the recent history, that in the past 2 decades, wages growth has only ever sustainably exceeded 2.5% when the unemployment rate has been less than 4%. And I think that's the sort of judgment that's informing the way the Federal Reserve is going to think about its monetary policy tactics. And that's also obviously had some impact on the way the Reserve Bank thinks about the notion of full employment in the Australian context as well.